Imagine standing on the edge of a financial cliff, peering into the abyss of uncertainty. The stock market, a towering giant, shows signs of faltering. The once invisible Magnificent Seven now cast long shadows over the market's stability. As of 2025, these seven titans makes up approximately 35.4% of the S&P's 500's total market capitalization, a concentration surpassing even the peaks seen during the 2001 dot-com bubble and the 2008 financial crisis. In the past 2 weeks alone, companies like Meta, Alphabet, and Amazon have seen their stock prices plummet by over 10%. This sharp decline raises pressing questions. Are we on the brink of another market collapse? The AI bubble. History has a way of repeating itself, especially in the financial world. Each major market bubble has been inflated by the massive appeal of a new innovation. 2001. The internet revolution promised a new digital era, leading to the rampant speculation and the eventual bursting of the dot-com bubble. 2008. The housing market was deemed an unshakable investment until the subprime mortgage crisis unraveled the global economy. 2025. Today, artificial intelligence stands as the beacon of technological advancement. Companies are investing heavily, with Nvidia stock soaring over 600% in the past 3 years alone, driven by AI-related demand. While AI holds transformative potential, the intense heat surrounding it mirrors the speculative manias of past bubbles. The critical question remains: is this growth sustainable, or are we fueling yet another market bubble? Warren Buffett's perspective. Renowned investor Warren Buffett, known for his wise investment strategies, has taken a notably cautious stance. As of 2025, Berkshire Hathaway's cash reserves has swelled to a record $334 billion, up from $189 billion at the end of the first quarter of 2024. This represents 30% of its total portfolio. This significant increase in cash holdings reflects Buffett's approach in the current market environment. But despite the substantial cash holdings, Buffett reassured shareholders of his commitment to equities, stating, "Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities." Buffett's reluctance to deploy this capital suggests a lack of appealing investment opportunities in the current overheated market. His strategy of accumulating cash reserves indicates a preparation for potential market downturns, reminiscent of his approach during previous financial crises. Warning signs. Several indicators point towards a precarious market situation. 1. Market concentration. The Magnificent Seven now represents over 35% of the S&P's 500's market capitalization, an unprecedented level of concentration. 2. Valuation metrics. The price-to-earnings ratio of the S&P 500 stands at 30, significantly above the historical average of 17.9, suggesting overvaluation. Recent stock performance. In early 2025, major tech stocks have experienced notable declines. For instance, Nvidia's stock has corrected by more than 10% over the past few months. 4. Economic policy uncertainty. The return of President Donald Trump has introduced potential trade tensions and policy shifts, adding to the market volatility. How likely is a recession? We cannot tell when or whether a market crash will happen, but over the past century, the United States has experienced over 14 market recessions, averaging one in every 7 years. These downturns have varied in length and severity, but they all share common triggers and patterns. Current economic indicators. As of early 2025, several indicators suggest potential economic challenges ahead. Consumer confidence. The US Consumer Confidence Index experienced a significant drop, falling from 105.3 in January to 98.3 in February, marking the most substantial monthly decline in over 4 years. Inflation expectations. Inflation expectations have risen to 6%, the highest since May 2023, influenced by concerns over tariffs and potential trade wars. Treasury yields. A notable decline in treasury yields indicates investor concerns about potential economic downturns, with the 10-year yield falling below key technical levels. Expert analysis and predictions. Economists and financial institutions have offered varied perspectives on the likelihood of a recession. In August 2024, JP Morgan increased the probability of a US recession starting before the end of 2024 to 35%, citing softer labor market data and slowing economic growth. Economists at Goldman Sachs have raised their estimate of the likelihood of a US recession in the next 12 months from 15% to 25%, maintaining that the risk remains limited. These facts coming together creates a warning sign for us. The similarities to past market crashes are clear, and the current situation is full of uncertainty. While the excitement around AI and technology is real, it's important to carefully consider the market. As we move through these challenging times, it's important to stay cautious and informed. History shows us that getting too excited without thinking too much about it can lead to major financial problems. The big question is, are we seeing another bubble that eventually will burst?